Good morning, Matt. John De Vries from BlackRock Mining. We're a Tanzanian graphite developer, and I use that word very carefully because we've gone from a graphite explorer to being a graphite developer, and it's particularly a fantastic time to be developing a world-class graphite project as the EV revolution really moves from being a rhetoric to something real. You can walk into many automotive showrooms today and buy an EV, and we just hope in a not too distant future that EV has some of our concentrate, some of our graphite in it, and we take a very significant role in not only advancing Africa but also decarbonising the planet. It's a pretty good reason to get out of bed most days.
It is. And you've got out of bed and joined us here in Cape Town. What are you ever here for?
Well, as I said, we're pre-development, so what we're trying to do now is front-end load the financing process.
Right.
Last week we completed a $25 million raise on the ASX, which has filled our treasury and allowed us to really start the early works program and really establish a platform from which we can come out in the second half of this year and move into construction at Mahenge.
Right. So we'll get into the finance and what you're going to be doing, use cases, etc. In a sec. Let's start with you. Because the first time we've met, we've spoken, right? And I've really enjoyed the conversation we had before the camera started rolling. Tell us a bit about your background.
As you can tell by the hair colour, I've been around a little bit.
20 years.
Yeah, I wish. I started in Kambalda mining nickel back in the early 80s, and I think it's ironic that I look at the nickel industry then, which is stainless steel. The nickel industry today is stainless steel and EVs. In my time, I've been around about 40% of my time is in offshore projects, supervising former Soviet Union, Pacific, and building projects in Africa.
Yeah.
So what I'm able to do now is to bring together 40 years of things I've learnt and 40 years of things I don't want to do again and put it together at Mahenge. It's been an honour to really take a project that is a world-class asset at exploration stage and put together our IP that we've learnt over the time and put together a really well-founded, well-reasoned resource development strategy.
Well, let's help people perhaps new to this, who've come in from the tech space or elsewhere, perhaps don't quite understand the vocabulary. So graphite, the space has evolved, and I think you told me before we started, even in the last 5 years, it's significantly different. So,
if you were to get in a time machine and go back a few years and talk about graphite, you'd always be talking about graphite and steel mills, because the primary demand for graphite was handling hot metal, be it either as a refractory lining for a steel mill or sitting in foundry sands. What we've seen is the world has moved into this EV alternative energy space. The need for energy storage has really pulled out a new rhetoric around graphite, and the highest growth rate at the moment is coming out of that EV storage. Poses a few problems for the sector. Is firstly, what was a good refractory may not necessarily make a very good battery mineral feed. So we're in a world where we're going back now and trying to understand what is the right graphite to mine and where does that graphite come from.
That's interesting, because it used to be as simple as, small flake, large flake, jumbo flake. That's all I needed to know. And maybe, coming under a little bit of pressure from the synthetic graphite as well. That was all it was about. So what you're saying in terms of the different types of graphite mines or operations out there, they've had to rethink what it is that they're going after?
Certainly. So if I start off maybe at the small flake. Small flake. If you think about a typical graphite mine, it's a crush, grind, float, and then we go into an attritioning process. When we attrition a process, you can imagine a flake of graphite, it's intercalated.
Yeah.
And what you have to do is break apart that flake of graphite to get rid of the intercalations, so you can get to something that's saleable, 95%. The advantage we have at Mahenge, by the way, is very little intercalations, means we don't have to do much breaking of the graphite flake. But if you're in a battery manufacturer, the chemistry of those intercalations matter a lot. So this is where people are now starting to go back and say, well, what works in refractory doesn't necessarily work in the energy industry, and really starting to look at alternative feedstocks. And I think the nuance overlay on that is that the traditional graphite industry is Chinese-owned. Chinese dominate about 70% of the global volume, and that's simply a function of the Chinese steel industry. As we start to look at, resource security and supply chain integrity. People are now looking at, well, are we happy with China owning 70% of a critical material associated with the energy transition?
Well, that's a big topic, which is affecting a few other commodities as well, as is sort of jurisdictional risk, very prevalent at the moment. Let me come back to this intercalation. Did you know what you had when you first picked up the asset, or has time and a sort of change in the market been your friend?
We learnt fairly early we had a unique block of rock. And it really talked to a couple of things we did differently in the development strategy of the project. So one thing we did very early on is we went and did a lot of battery tests. We did those battery tests back in 2017, 2018.
Right.
And in those tests, it indicated our material performed a lot better.
Right.
And when we looked under the scanning electron microscope, we kind of had lumps of graphite as opposed to something that looked like a club sandwich. So it gave us a pretty good hint we were onto something special. What we then did is step back and say, well, what's the right development strategy for the project?
Right.
And there's really a couple of alternatives here, but the strategy we hit upon was developing a modular approach, so it's easy to execute. But the module was sized so that it was big enough to be investable, small enough to be fundable,
Right.
so we're not trying to overreach. And critically at that point in time, the amount of product we put out wouldn't damage any of our price points. So a lot of work went into that. Once we'd worked that bit out, we then transitioned to a very, very intensive qualification phase.
Yeah.
And that took us 4 years.
So this bit's really interesting to me, because that's the smarts. You say, right, we need to kind of show a kind of route to market and maybe earlier revenue, right? But without damaging the potential scale of this operation and people's perception of what it is that we are. So we might look too small if we go early, but at the same time, we've proved a lot of things to a lot of people. And is that how you attracted POSCO on board?
POSCO came on board as part of the qualification strategy.
Right.
So what we did early on is we're trying to get our flow sheet right.
Yeah.
We ran a 90-ton pilot plant in China. At that point, that pilot plant was an order of magnitude larger than anybody else's.
Right.
And it was simply done because we didn't know a lot about graphite. The Western world doesn't know a lot about graphite. Yeah. And it actually took us 5 different circuit configurations to get it right.
Right.
We're able to put concentrate out to a number of people.
Yeah.
And
how many typically do you put these out to?
We put it out to 29 different customers.
Right. Okay.
And we had 7 come back and say, let's talk.
All South Korean?
No. 1 South Korean, 6 Chinese. And 1 Japanese.
Okay. But not a lot happening in the West, as you say. I mean, it reinforces your point.
The West has become, at that point in time, the West was content to allow China to be the factory of the world. I think that dialogue's moved on.
Yeah.
But at that point in time, and this is where the supply chain issue sits at the moment, is that China, being the manufacturing centre of the world, consumes most of the raw materials. So if you are going to work in this space, you have to work with Team China.
But we've seen a few, like if we take other commodities and the rare earths, for instance, right? There's been this sort of pushback there from, various countries about, mineral security or critical minerals list, however you want to frame it. But also some pushback with the way that China was manufacturing these rare earths in terms of, there's a little bit of NIMBYism here around the world with mining at the moment. Perhaps we should avoid that topic. But the way that China was doing the environmental damage that was being done with rare earths, was it the same in terms of what you're seeing with graphite? People concerned about the way that graphite is being produced?
There's 2 layers in which that occurs in China. Firstly, the raw graphite production, and the mines aren't world class. Call a spade a spade.
Yeah,
they're not world class in the way they manage their externalities, their community footprint, their environmental footprint.
Yeah.
So that was part one, but also China owning effectively 3/4 of the raw materials supply. The second issue is more of a global issue. And when you make your spherical purified graphite, which is the anode precursor, The one route that works at scale at the moment is the hydrofluoric acid route, which is dominated with China. And China does that, holds that space for a couple of reasons. You need to think of this not so much as a spherical purified graphite industry, it's a vertically integrated supply chain. So in a typical SPG plant in China, 3 tonnes of concentrate go in.
Yeah.
You produce 1 tonne of precursor, anode precursor. You produce 2 tonnes of dust. That dust is used as recarburizing feed in a steel mill.
Right. So hence POSCO are interested in, because I was trying to work out, again, for the people who are not aware of all of this, POSCO, South Korean steel manufacturer, is that what they do?
No. But it's a different story how POSCO got into this one. But if you think about the SPG story, 3 tonnes in, 2 tonnes of dust that go to a steel mill.
Yeah.
So for this industry to be viable, you need a steel mill in the backyard.
Yeah.
You need hydrofluoric acid to purify the HF, the SPG. So typically that comes out of vertically integrated chemical industries or pharmaceuticals.
Yeah.
So when you go to Shandong province and we go to, new materials and people like that, there's a steel mill down the road and there's a pharmaceutical plant across the road.
Right.
And that's why China's sat in this space with this HF route.
Got it.
Now, at the moment, there's a bit of an arms race to find out, is there an alternative route? And there's a lot of people working in this space. Now, critical to our strategy is going, we're better miners than we are chemists.
Yeah.
So we stay upstream and we have a relationship with POSCO on the downstream side.
Got it. Okay.
So it's just...
And is that the model going forward, as far as you're concerned?
Well, the fundamental business model we go is with our modular approach, is we build a module that's not too big, not too small, and that produces us, an EBITDA of $40 or $50 million a year.
Yeah.
From that, we buy a second module, a third module, and a fourth module. And the nuance here is because Mahenge is the 4th largest resource on the planet and has the biggest measured resource, having qualified module 1, module 2 can come on at the rate I can build it. I don't have to qualify module 2. I don't have to qualify module 3. I don't have to qualify module 4. We can react to market signals very quickly.
Smart.
That's why we put the effort into getting module 1 qualified.
Okay, so let's talk about where you're at today with this, because you brought this to, you're in the final few yards of this project, right? You've got your environmentals in place, you've got your license in place, you've got, a social license. Let's talk about that, because Tanzania, a beautiful country, beautiful people, done business there myself. They must be pretty excited about what you're trying to do there.
Tanzania has gone from being really challenging to really quite friendly, and certainly we arrived there. I arrived there in 2017, and it changed from a good environment to a challenging environment fairly quickly. We realised we're sitting on a world-class resource, and you don't walk away from a world-class resource. So it's a matter of buttoning down and pushing through. Probably a testament to our endurance is I went over to Tanzania in August last year, knowing I was unable to return to Australia. I only got home on the 5th of March this year, and had to spend 4.5 months in Tanzania working through the resolution to that free carried interest, because without resolving that free carried interest, we were unable to take the project forward.
Right, and what did that end up looking like?
It is ironically the same economics we forecast in the DFS back in 2018, 2019.
Okay.
So the government has a 16% dividend participation right. That's in their free carried interest. And, this gets back to the whole ESG argument about, what's ethical and what's right. The way it balances in Tanzania, 30% tax rate, 4% royalty, 16% free carried interest. Effectively, the nation has a 50% interest in the project economics. Now, what does that mean for us? Look, at a very high level, it means Tanzania wants the same things we want. and that is Tanzania wants to get the project built.
Yeah.
Tanzania wants to see the jobs created. Tanzania wants to see the foreign exchange coming into the country. So I think what it's done at a high level is produced a sort of alignment that we'd like to have.
Well, I think that's fantastic. I think it's very topical at the moment, and we've seen lots of conversations, proposals in South America, which people are a bit uncomfortable with. But I think Africa has always been a good place to mine, good place to do business. It's slightly easier, possibly, than some some Western jurisdictions, one could argue. And I think people need to appreciate that.
What I like about Tanzania is there is this concept of British law that sits there, and the law is the law, and people will apply the law.
You're not talking mining law here, you're talking just
general law.
General law, yeah, right.
It gets a bit clunky at times, but fundamentally the law is the law. So compared to a lot of other jurisdictions I've worked in, I call Tanzania Africa light.
Yeah, that's fair.
And certainly compared to some jurisdictions I've worked in Australia or in North America, I know where I'd be easier to work in, and that's Tanzania at any day. The worst thing you'd be is British Columbia with the copper gold project, which will take you 15 years to get an environmental permit. We know we can do that in Tanzania in 12 months.
Yeah, and that's, like I said, I think it's a very enabling government. The attitude of the government is fantastic in terms of they want this foreign direct investment. They do want the jobs, but you've still got to do things the right way. You've got to go through a process. There's no shortcuts here.
Look, I think anybody who's responsible in business wants to look back and say, I did good, not I cut corners.
Yeah.
And that's really what motivates us at the end of the day. We want to sit back and know we've done the right things right.
Right.
And we've created opportunities for our shareholders. We've created opportunity for our stakeholders in country as well.
Well, let's look at that. Okay, so you're doing good because you want to do things the right way. It's your reputation, your brand. You're doing the right things for the country and the people there. But for your shareholders too, the economics stack up. So I saw the IRR was, pretty punchy.
Pretty staggering.
Yeah.
And that gets back to a couple of different strategies about how you go back and develop a project. I go back to the modular approach, where we get module 1 up and going. We put in the infrastructure. We train everybody to operate module 1. And we put in module 2, which is exactly the same as module 1, then module 3, and then module 4, all of which gain us economies of scale. So for want of a better word, this is building an airline out of A320s, one at a time, as opposed to buying one big A380.
Yeah.
And it really gets back to letting us be in charge of when we add capacity and how we add capacity.
Okay, so let's talk a little bit about the market and where this going. Obviously, commodity prices generally across the board are quite good at the moment. For graphite, is it sustainable? What does that supply-demand deficit look like going forward? What's the expectations? And also, if you can bring in the synthetic component here, because it was always synthetic was on the rise, and then it kind of overtook natural, and now natural is making a comeback. So what's happening there?
So in graphite, you need to think of, we produce 5 products that go into 3 distinct markets. The very large material, which we call plus 32 mesh, gets called jumbo, super jumbo. That goes into a foils market. And foils are thermal management film. And if you buy yourself a mobile phone, I think about the foil sitting in that as opposed to the graphite and battery, because the foil protects the screen from heat damage. So 100-inch TVs get me excited. There's a lot of graphite in there. There's the mid-size, which get called large, which is typically plus 50, plus 80 mesh. That material there will go into expandables. So we're talking about fire suppressants, door seals, gaskets, thermal management. And again, that's a burgeoning market. This is a market that's screaming for supply. And then there's the fines, which goes into traditional refractories and increasingly EV space. When you build an EV battery, you design it for a certain performance level. So natural flake will have a higher charge.
Okay.
Synthetic charges faster. So what you're trying to do is to dial the ratio. Now, the other thing that you're finding is synthetic tends to be more homogeneous than natural. Why? Because the Chinese industry, which is a dominant supply, is dominated by a series of small mines, and you're trying to blend the problem away.
Right.
The solution is large homogeneous mines such as Mahenge.
That's interesting, the blending of it. I hadn't really thought of that.
The second nuance on that is the arms race in the cathode chemistry, where we're going from LFP, which is cheap and cheerful, through to the higher performance NCM batteries. And there's a very significant cost difference between an LFP battery and an NCM battery. In reflect of that, you also need to adjust your anode chemistry. And it's much easier to adjust the chemistry in a natural flake element of that anode, because you can intercalate silica and other elements in that to enhance that performance. So we're seeing that combination of cost at the top end of high battery performance is driving people into the anode space to review the anode chemistry and see what they can do. And that's really only possible when you're dealing with a homogeneous natural flake. John's laws of batteries there: for every cathode there's an equal and opposite anode. So we're in that space, which is good.
Not bad. Let's talk money. You raised $25 million recently. You're in the sort of engineering phase of this. I want to kind of bring it back to what our investors are looking forward to, right? Relatively low capex for phase one, but you still need to get that in place, right? You need to get this debt. You referenced earlier, it's slightly harder to kind of get the debt until you've got a few things in place. So where are you?
So the strategy, and this gets back to some decisions we made 4 years ago about going down the pre-qualification route. So if you go down the pre-qualification route, you can attract an anode producer. And in our case, we've got POSCO standing in. POSCO now owns 13% of the company, and they're standing in there for a life of mine offtake from Module 1. We do have interest in Module 2 already, and POSCO will stand in the market for 10.
So is that 100% of life of mine?
Yeah.
Okay. So there's no competition. Do you think you got a good price because there's no competitive tension there? You're happy.
We're happy with the price. Okay. I think we're in the right spot. What's the word? We're unhappy with the price. POSCO's unhappy with the price. So I know we've ended up in the right spot.
Right. Okay.
So bringing in a balance sheet like POSCO means we can get a contract. We get a contract. We get debt. If I get debt, I don't have to dilute the registry. So that was a strategy, a decision we made 4 years ago about how we're going to tackle this space. Now, that pre-qualification is not a simple thing to do. There was a 90-tonne pilot plant back in 2018, 2019. Yeah. We produced concentrate we took to China. The Chinese didn't believe the quality of the concentrate. Not possible. We took a container load across to China. We ran a 20-tonne pilot plant in China, and we basically gave away show bags of concentrate on that to prove we could make it. And then as we matured the relationship with POSCO, we then milled 500 tonnes of ore to produce about 40 tonnes of concentrate, and a semi-trailer went to POSCO. We ran it through a commercial facility to validate how it would perform in both a commercial facility and then how it would perform downstream in EVs.
Okay, interesting. So where does that leave you today? So the question is still there, is what's the time on getting the finance for the CapEx and obviously OpEx requirements?
So we're completing the contracts now with POSCO.
Yeah.
We're also putting together MOUs, offtake agreements for large flake with some of the more traditional Western users.
Right.
And we have 1/3 of our product going into China. Now, people will talk about, the China supply risk, and I think we can all understand it. Contracts in China are concepts. And how much of a risk does that mean? About 1/3 of it, the feedback from the banking syndicates is they're happy with that. But certainly, there's massive demand in China for our product, and ultimately, China is still the factory of the world, and they make things, and graphite goes into things that are made. So, it's a supply chain that will go in there for quite some time.
So just to appease the people who maybe have concerns over that, what controls do you have in terms of China, late payments and stuff like that? 30 days, 60 days, 90 days becomes 365 days.
No, it's letter of credit in the bank before the ship leaves. Thank you very much.
Good stuff.
Yeah.
Okay. And in terms of, some of the kind of Western potential buyers, potential partners. You talked about your construct for that earlier. Are you in discussions? Are you keeping the door open on those discussions for modules 1, 2, 3, and 4?
This is again the advantage of the modular strategy.
Yeah.
Modular 1, just about sold out now. Module 2, we're getting inbound inquiries. And then these are sort of brands that, you would have died for 12 months ago. But, we're now dealing with multiple inbound inquiries. And it's not only inbound inquiries from corporates.
Yeah.
It's inbound inquiries from government agencies saying, we have a security supply issue.
Got it.
How can we facilitate this? And it's kind of exciting.
That is, yeah.
It's interesting, and this whole thing comes back to a simple... there's a common rule across all of those government inquiries, and that is you need to have 4 green ticks in the ESG box.
Right.
But working through that's a condition of bank debt anyway.
Yeah.
So again, you can sort of see the multiple layers of why we've gone down pre-qualification, get a contract, do it right, get bank debt.
Yeah.
Suddenly that opens up a whole plethora of opportunities.
So ESG is a real thing as far as whether it be export credit agencies or other funders. It's not just a tick box exercise. It's a real thing.
We've taken ESG. This is an interesting approach about how to think about ESG. Again, like I've been in the mining industry now for 40 years.
Yeah.
And I think of ESG as being the safety case, but looking outside. The safety case is you look inside into your operations. You say, what risks can I minimise? Because risks equal economic loss. So that way, safety is good for shareholder value. We know a safe mine is a profitable mine. ESG is a safety case looking outwards. You turn around and say, what are the externalities of my operation? Is my operation a net benefit or a net detractor? So if I think about the bones of our ESG footprint in Tanzania, we are looking to run the mine off grid power. Grid power in Tanzania is 70% hydro, 30% gas. So massive tick.
Yeah.
From an economic point of view, it's 8 cents a unit versus 32 cents a unit if I'm running off diesel.
Yeah.
I'm using dry stacking. I'm using dry stacking for a couple of very good technical reasons, but it means 85% of my water is reclaimed going back to the mine. I'm not in competition with the subsistence agriculture area. So again, I am being a good neighbour to the subsistence agriculture in the area. I think also about the low strip ratio approach that we've developed on the mine and taking a whole of ore body approach. Again, I don't have massive spoil piles that are going to detract and simplifies mine reclamation going forward. So it's about actually building ESG and how you address the macro issues of ESG into the footprint, into your mine. And then there's the second layer, the governance aspect about where you work in with the Equator Principles. Again, we've done a reasonable job there. We've had the independent technical experts come through. And yes, there's a bit of catch up in 1 or 2 areas, as you would always expect. But fundamentally, we've done a pretty good job in that space.
Good. So expected timing on when this phase 1 module starts being built?
We probably have a couple of months to go yet to finalise our debt. Right. We have 30 million cash in the bank now, so it gives us an opportunity to get going in some of the early works program, roads, etc. And there's some discussions at board level that'll be occurring in the next week or 2 about how we might go about doing that. I think, we'd really want to have line of sight on the debt to equity puzzle towards the end of Q3 and, understanding when we can draw that debt sometime in Q4. We're still thinking of a view that on the timeline we're looking at, Module 1 will be getting wet at the end of next calendar year. I wouldn't have thought that I'd say this 20 years ago, but it's only 1 million tonne a year. And that's a reasonably modest mine. And, the modular approach means a simple construction period.
Yep. Of how long?
About 15 months to build.
15, 18 months. So okay.
That's pretty useful. We did that because we wanted a short, sharp execution because it means it's simple from an execution point of view. But interesting in an inflationary environment we're dealing with now, a short duration means the opportunity of a inflation-driven cost blowout's minimised.
Well, exactly. I think a lot of companies are going through this. Certainly, if they've done economic studies, there's earlier in the year they're slightly regretting it. Peak inflation it seemed, but I guess the chance of being affected by inflation and supply chain issues, if it's a small project, is less. The impact is less.
The Economic South project, if you go back and you look at the high-level economics, back in 2019, we looked at the project costing $116 million US. And if you turn around and you look at a basket price of $1,300 a tonne, and that we can mark to market that basket price today, cash cost of about $400 a tonne. We're bringing in $3 of revenue for every dollar of cost. You don't often get a business that does that. And that's a pretty remarkable business. And an NPV 10 after tax, after free carried interest is about $1.5 billion US.
No, the numbers are vast, and I love the fact you're using NPV 10 when we're all doing an NPV 5 just to make it look a little bit better. But that's why I asked you earlier about the sustainability of the pricing. It sounds like the market is there, pricing is sustainable, and you've got your offtake partner in place.
Yeah. So what we've done is, again, this pricing piece has been opaque.
Yeah.
And it's been one of the big challenges in this is it's been easy to get on a stool and proclaim I've got Super Jumbo that does all these things.
Yeah.
We've spent a lot of time working with Chinese markets, and we have our own internal pricing now, and every quarterly and every price deck we put out, every investor deck we put out, we now have our pricing pages on that.
Okay, good.
And we synthesize 3 internal Chinese markets. So we look at what's called refractory windows, which is a Shandong-based index. And Shandong's important because that's where the steel industry is, and it's also where the processing industry is. So that gives us kind of an insight as to what Chinese export would look like. We've got Heilongjiang, which is where Lubai is, and that's 900-pound panda in the production. And then ICC Sino, which is in Inner Mongolia, and that tells us roughly what we think the large float price would be. And we produce a blancmange of those. And our basket price that we talk about in our economics, we can mark that to market back to what we're seeing as Chinese transacted prices. And that's pretty important because while we would all like to say that because of the security supply issue, therefore the West will be prepared to pay more, the reality is consumer behaviour is they'll always buy the cheapest. So if you can't have a mine that survives on a Chinese pricing index, you've probably got a bigger problem.
Yeah, marginal projects, I think, well, the tide's gone out, let's put it that way, for some of these marginal projects. Okay, so we're looking at 2024 production, 2024 revenue on Module 1, is that right?
Late 23, early.
Late 23, okay.
Yeah, I think we'll get it wet in 23. It'll certainly see cash flow in 24.
Great, okay. Well, John, great introduction to your story. Really enjoyed that and learned a thing or two. That's always useful. Stay in touch. Let us know how you get on with things as they progress this year. Be intrigued to see how you get on.
Okay, thank you.